No fluff, just fundamentals. Today, we're running a detailed stock analysis on Portland General Electric, ticker POR. We're looking closely at the underlying risks and the real growth drivers. Let's get right to it.
Okay, let's dive into this. Portland General Electric, or PGE, is an Oregon-based regulated electric utility serving over 950,000 customers across 51 different cities. We're looking at a company with a very solid, diversified foundation here, owning and operating more than 3,500 megawatts of generating capacity. And this isn't just one type of power. It's a highly diverse mix of hydro, natural gas, coal, wind, and solar assets. Understanding this broad footprint is absolutely essential because it sets the stage for exactly why this utility is catching investor attention right now. This is a massive, established infrastructure play.
So what's the core investment thesis here? Well, based on the analysis, POR is rated as a moderate buy or a stock to accumulate on weakness. Now, it's vital to set your expectations correctly right from the jump. If you're looking for a high-flying tech stock that's going to double in 6 months, yeah, this is not it. This is a story about income and long-term rate-based growth. The whole bull case here is built on those predictable cash flows that come from regulated utility economics. They're actively expanding their rate base to meet growing electricity demand in Oregon, and as we'll see in a minute, there's a major transaction on the horizon that could materially change their trajectory.
And for a lot of investors, this number right here is the main attraction, a 4.4% dividend yield. At a share price hovering around $50, an annualized dividend of roughly $2.21 per share gives you a very meaningful yield in today's utility sector. Now, a quick word of caution when you're doing your own screening. If you look at standard accounting metrics, like the GAAP payout ratio, it might look unusually high. Don't let that spook you. For a regulated utility with massive infrastructure depreciation, you shouldn't evaluate dividend safety solely on those standard earnings. The real focus needs to be on regulated cash flow growth, capital spending, and rate case outcomes. The final verdict on this dividend? The yield is highly attractive, the growth potential is moderate, and the safety is reasonable. It makes this an income and moderate growth play, rather than a pure dividend growth compounder.
Now, this next part brilliantly illustrates the difference between short-term noise and long-term structural earnings power. Looking at the recent quarterly performance, Q2 was decidedly mixed. They posted an adjusted EPS of 64 cents, which missed the consensus estimate of about 74 cents. Revenues also came in slightly light, and Q1 showed some pressure as well. But, and this is the absolutely critical takeaway, look at what management did next. Absolutely nothing to their full-year guidance. They held firm, maintaining their adjusted EPS outlook of $3.33 to $3.53. This tells us management views the quarterly weakness as just a temporary blip, not some structural deterioration. The stock doesn't need spectacular, immediate earnings growth to work. It just needs steady, reliable execution.
So, how does that steady execution translate to valuation? If we take that maintained EPS guidance, and let's just use the high end of $3.53, and divide it into the current share price of roughly $50.33, we get a forward price-to-earnings multiple of about 14.3 times. Even if you use the lower end of their guidance, you're looking at around 15.1 times. In the world of regulated utilities, paying 14 to 15 times forward earnings for a company paying a 4.4% dividend with a 5 to 7% long-term earnings growth target, that's actually quite reasonable. Honestly, it's one of the most attractive aspects of POR right now. You simply aren't overpaying for the underlying cash flow.
But the income? That's only half the story. The biggest growth catalyst, and arguably the absolute most interesting part of the POR narrative, is the planned $1.9 billion Pacific Corp Washington transaction. PGE has partnered with Manulife Investment Management to acquire selected utility operations, generation, and transmission assets up in Washington. To understand why this is such a massive deal, you have to understand how utilities actually make money. Utilities grow their earnings primarily by growing their rate base. More infrastructure means a larger rate base, which means regulators allow the utility to earn a return on a larger pool of assets. That ultimately drives earnings growth. If executed correctly, this transaction gives PGE a significantly larger platform to work from.
But we do need our reality check here. Look at the sheer scale of this transaction compared to the size of the company itself. The Pacific Corp acquisition is a $1.9 billion endeavor. That single transaction represents roughly 1.4 times their estimated 2026 rate base. Now compare that to PGE's total current market capitalization, which sits at around $5.9 billion. A $1.9 billion transaction is just enormous relative to a $5.9 billion company. This introduces a very heavy burden of capital and financing requirements. As an investor, you have to closely monitor how they're going to fund this. It's going to be a mix of debt, equity, regulatory approvals, and allowed returns. It's a huge opportunity for sure,
but it requires some heavy lifting.
Historically, utilities operated in these very slow growth environments. You bought them for the yield, put them in your portfolio, and went to sleep. But look at the macroeconomic tailwinds driving electricity demand today. The landscape is radically shifting. Now, what's really interesting about this slide is the sheer explosion of AI and data centers requiring massive power loads. Add to that widespread EV adoption, industrial and building electrification, and this huge push for reshoring manufacturing back to the US, all of which requires a modernized grid. PG&E is geographically positioned perfectly in the Pacific Northwest to directly benefit from this economic growth. The demand environment is potentially the best it has been in decades.
To meet this accelerating demand, PG is aggressively transitioning its grid. Looking at their generation capacity exposure, they aren't just abandoning the reliable baseload power. They're smartly retaining their hydro, natural gas, and coal assets to ensure the lights actually stay on. But the real growth, that's happening in renewables. They've announced agreements for 615 megawatts of solar and battery hybrid projects, of which PG is going to own 425 megawatts. This perfectly positions POR to capture the upside of the renewable energy transition, battery storage, and grid investment, all while keeping the conventional reliability that both regulators and customers absolutely demand.
So, we need to talk about the catch, and this is where the analysis becomes much more cautious. Because electricity infrastructure is incredibly capital-intensive, utilities naturally carry a lot of debt. But POR is entering a particularly heavy period of investment. We're talking grid modernization, renewable projects, that massive Washington expansion, and ongoing infrastructure maintenance. They need constant access to debt and equity markets to pull this off. Case in point, PGE recently announced a massive public offering of 9.47 million shares. That proves they are willing to use equity to fund growth, which means dilution is a very real consideration for you as an investor. Rate-based growth is really only valuable to you if the return on that incremental capital actually exceeds the cost of financing it.
Weighing the bull and bear cases side by side reveals a pretty clear divide. The bull case paints a beautifully compounding machine. The Washington acquisition succeeds, the rate base expands alongside all that accelerating electricity demand, EPS hits that 5 to 7% annual growth target, the dividend grows, and the market rewards the stock with a higher valuation multiple. That's a clear path to high single-digit or even low double-digit total returns. But the bear case acknowledges some very real risks. What if regulators push back and just deny those rate increases? What if these massive capital requirements lead to severe equity dilution? Or what if interest rates remain elevated for longer than expected, making utility dividends look a lot less attractive compared to treasury bonds? Both of these scenarios are entirely plausible.
To ground all of this in actual numbers, we can apply a fair value framework. If we assume a normalized EPS of about $3.43, which is right in the middle of their guidance, we can map out potential share values. At a 15 times PE multiple, the stock is worth about $51. That's exactly where it's trading right now. But if they execute well and the market expands their multiple to 17 times, you're looking at $58 a share. At 18 times, it reaches $62. What this math tells us is that the stock isn't dramatically undervalued right this second. It's fairly priced. The real upside comes from the company proving they can actually compound those earnings toward the upper end of their 5 to 7% growth target over the next few years.
Bringing it all together into an investor scorecard, this explainer gives Portland General Electric an overall score of 7.8 out of 10. It earns a perfect 5 stars for revenue stability because, well, people are always going to need electricity. It scores a very solid 4 stars for overall business quality, valuation, and that current dividend yield. Where it takes a bit of a hit, scoring only 3 stars, is on the balance sheet and dividend growth potential. That heavy capital expenditure phase we talked about, along with the resulting debt and potential dilution, really weigh down those specific metrics. But overall, a 7.8 is a strong, definitive showing for a steady, defensive equity like this.
So, what's the final verdict, and where are the target zones? For the long-term investor, the rating is accumulate. For an income investor, it's firmly attractive. The preferred accumulation zone, that sweet spot where the risk-to-reward ratio heavily favors you, the buyer, is between $44 and $48. If it drops below $45, it becomes substantially more attractive. Now, right around $50, where it sits today, it's a reasonable entry point for a long-term income investor, but it's not exactly a screaming bargain. If the stock pushes above $55 to $58 without a corresponding rise in earnings estimates, you definitely need to become much more selective.
Which leaves us with the most critical question of this entire analysis.
Can PGE successfully turn this massively expanding capital base, especially that $1.9 billion Washington acquisition, into a sustainable compounding machine without diluting existing shareholders through endless equity raises in the process? It's a steady transformation story with some incredible demand tailwinds, but execution is absolutely everything here. You've got to keep a very close eye on their capital requirements and how they navigate their regulatory approvals. That is going to be the ultimate deciding factor for this stock.